Hi, Tim Bigham back again this week for Traders Exclusive, and what a week in 2 days almost, to say the least. I mean, the intraday volatility is nearly astounding here. Went back since the non-farm payrolls number when the market made that all-time high on the opening. Since then, the daily average rain has been well over 1.25%. Before that, the past 30 days previous to the NFP coming out, the daily range was somewhere around 70 basis points. So almost a double in the trading range intraday, so we have some volatility here, to say the least, and today encapsulates that. The S&P futures were up 12 near their highs of the day. Last I looked, they're down about 7, so we've already had well over a 1% swing, and we're barely an hour and a half into the trading day. So I think until further notice, this will be the mantra as we're trying to digest a lot of things here. The Fed tapering, valuations that aren't cheap, certainly the Ukraine on the front there, and probably most importantly, China with a big slowdown. We see copper getting taken out to the woodshed today. That usually is a harbinger for the market. The Baltic Dry Index down probably 17 days in a row. Looks like it's going to close down again today. That doesn't bode well for the world economy. So, really sort of a very difficult situation to be bullish equities here, sans the Fed free money printing. And that's really, I think what investors are hanging their hat on here. Earnings have come out so far, trickling out, have been, okay. But again, we're trading at, over a 17 forward PE. So, not a inexpensive market, to say the least, up in the upper 10% of normal valuations. You take out the NASDAQ mania and we're in the upper about 4%. So I'm very cautious here. I've been very cautious for a while. Did miss a lot of that rally. Now we're back to levels where it's starting to look a little interesting. I'm actually, for the first time in a long time, looking at selling some out of the money put spreads here, given the fact that the VIX is back up towards 17, and we can get some nice option premiums here using about a 1 standard deviation out. For example, on the SPY, which is trading about 182, a 1 month one would put you about 5% out of the money. I would look at that area there. So, looking somewhere around a, 174 strike to be selling, buying the 170 as protection, collect some premium there. And to hedge that, sell some upside, the same sort of scenario, using 1 standard deviation out about 5%. The fact that the VIX is up means you can move further out of the money to get the same kind of net credit on these spreads. And, in essence, that's what I look to do, is find safety rather than credit. I want to be at a level where I feel comfortable. So using that same methodology, I'd be around the 190 level on the SPY to the upside, kind of, plus or minus 8 points here, looking for the market at some point maybe to find a little bit of valuation to hang its hat on here once everyone kind of gets out of the way. Certainly momentum names have felt the drubbing. Tesla looking like not only breaking 200 yesterday, looking like it's going to break 190 today. The other names out there feeling the same effect. The names that I kind of alluded to, you want to be cautious with, they're finally having their comeuppance. So until next week, this is Tim Bigham, as always, and especially in this market environment. Keep those position sizes in place and those stops going, and make sure you live to trade another day. Take care.